The economy is filled with uncertainties. Investors are anxious over the future of the markets and the world. And now more than ever, you need to be prepared for what's next and understand everything you need to understand about investing, trading, finances, how all these things play together, the macroeconomic landscape, and how everything ties into your bottom line. Gareth Soloway, Chief Market Strategist of InTheMoneyStocks.com and President of Verified Investing Education, joins me today on the David Lind Report. What an honor, Gareth, to have you as my first guest. Welcome to the show, and to the viewers, welcome to the David Lind Report. Thank you for joining me today.
Oh, man, it is a pleasure and an honor to be your first guest, David. Congratulations on the new show. And I'm excited to get into the hardcore macro and stock charts and crypto charts and all that fun stuff with you.
Excited to get your take on stocks, gold, Bitcoin, and the economy. Now, Fed Chair Jerome Powell, in his testimony earlier today, did indicate that while inflation has been coming down, it's still nowhere near the Fed's 2% target, and therefore they may raise interest rates at an even faster pace than expected. The markets didn't take this announcement very well. The S&P 500, as you know, fell on the news along with other stock indices. Now, despite today's downturn, Gareth, the stock markets have had a pretty good quarter four in 2022. Some might even say we're primed for a bottom because the stock markets have been consolidating for the last 2 or 3 months. Is this the bottom, Gareth? Are we due for another rebound, another bull rally, if you want to call it that?
So according to the charts, it's saying not so much, right? It's not to say we can't have a little upside, but there's still some major headwinds that the market has to digest out there. And interestingly enough, if we look at the S&P 500, in fact, let's jump right into the charts. What we can see is that basically from the initial move down, when we bottomed out in approximately June of 2022, we've now seen this sideways chop. And again, look at that. Really, the low here, I mean, you briefly violated it in October, but aside from that, you've been going sideways for a long period of time. Now, when you're a technician like myself, you start to recognize that a pattern like this is what we call a wedge pattern, right? And there's a defined wedge pattern here that unfortunately is more of a bearish wedge, right? You have a down move and then the wedge of consolidation is occurring here. So to me, it's a matter of time until the next leg comes in here. We're seeing the dollar pop today. That could be a headwind if the dollar continues to strengthen, as it's telling us the Fed may continue to raise rates. But bottom line is, investors should be very, very careful. I myself am mostly short at this point in time on the markets, just waiting patiently for that next leg lower.
When you're executing any trade, and we'll get into the specifics later, but just you're short on the markets right now, do you have a physical stop in place to ensure that you don't overextend that short position?
Yeah, so this is tricky, right? So I'm a trader. I'm at my computer 24/7 almost. I mean, I sleep a little bit, but for the most part, I'm always monitoring during market hours. So I use what I call mental stops. The reason why I'm a little cautious on physical stops is when you deal with significant size, the algorithms can pinpoint where your levels are, and they tend to run your stops. And the term run your stops means basically they say, oh, there's this many players at this price that have a stop. Let's quickly tag them, make them get out of their positions, and then we'll move it in the correct direction. So for me, I'm a big fan of mental, as long as you have the discipline, which a lot of people don't have. But if you have the discipline to go by mental stops, then you want to use mental stops versus physical.
All right. Let's assume I don't have any discipline, which based on what I've seen from the trading world, most people don't. So let's execute that stop. What's the level that you decide relative to the buy level? How do you make that decision?
Yeah, so at least in terms of the charts, right? So let's go back to the S&P 500 and take a look here. So what we see here is that you're in this wedge pattern. If we were to break above this wedge pattern, you'd have to assume this is the beginning of a move up. It doesn't mean we're going back to all-time highs, but we're likely going up to this 4320 level on the S&P 500. So really, once you're above this yellow trend line, that would be where you would say, okay, you now have to exercise that mental stop or physical stop and exit the position. But right now, again, notice we're having a nice little down day. We're hammering on this trend line. If this trend line breaks, this is where the next leg lower should kick in. And ultimately, I think I still have it pinned in that we're going down to pre-COVID levels on the S&P 500. That's around 3375 and potentially as low as 33,000 on the S&P.
Let's just talk about what's been happening over the last couple of months. Now, as we've discussed prior to that chart, the market has been on an upward trend. Is this mainly due to just a technical correction upwards, or perhaps we're seeing a recovery in the economy? Many economists would disagree with that statement I just made. Or perhaps the Federal Reserve has become less hawkish, which is bullish for risk assets. What would you pin this upward movement on, Gareth?
So number one, it's partially technical and it's also psychological, right? So you've been in this bear market for a long period of time. We've seen big names like the GameStops and the AMC's run. We've seen Coinbase have big moves. And so there's this kind of psychological want from investors that they want to see the revisiting of the craziness of 2021. The problem is the differences are enormous. You don't have the government sending out checks. You don't have interest rates at zero. You don't have massive quantitative easing. And so you're getting these kind of buy the dip mentalities of coming back in, hoping that the bottom is in. The problem is, and by the way, the bottom being in is being driven by a narrative that the Fed is getting close to halting their hikes and actually lowering rates. I disagree with that. I think they are getting close to the end of the rate hike cycle. I just don't think that they're ready to lower rates, especially with some of the inflation data that we've seen recently. So we'll probably see a 25 basis point hike in the next couple of weeks from the Fed when they have their, I think it's March 22nd meeting. But ultimately, the big kicker here is that you're going to see 5% interest rates for a long period of time. The Fed has made it clear they don't want to repeat the issues that Paul Volcker met in the 80s, and that's going to be what's going to really drive the economy into a recession.
Now, I know that you and I have spoken about this issue before, which is the possibility of a multi-year, perhaps even a decade-long bear market where we're not going to see new all-time highs for a very long time. Gareth, I'm just going to pose a counter argument or challenge, if you will, and that is, in the past, we've seen higher interest rates even than now, even than 5%, and bull markets have existed during higher interest rate environments. So the notion that higher interest rates will likely drive the markets down, we've seen historical precedents of that being the complete opposite. How would you respond to that?
Yeah, so I think you're in a totally new environment, right? We've been addicted. It's an economy, an investable market that's been addicted to interest rates. In fact, it's so crazy. Like if you talk to economists, if you talk to investors, what do they say? They say, oh, don't worry. If we go into a recession, the Federal Reserve will print money to get us out. Think about that statement. You're basically saying that the economy can't get us out of a recession by itself without the help of printing of money. And that's ludicrous, but that's the situation that we're in right now. So you have to be on the awareness side that at this stage, the Fed is going to be very nervous. They've been bitten by the inflation bug. Remember, they said transitory. It was anything but transitory. And that's going to make it a situation where they're going to be very reluctant to lower rates unless inflation goes below 2%. And I don't have that penciled in for multiple years. So what is that going to mean? It's going to mean we're going to slip into a recession. Essentially, they're not going to lower rates to get us out. They're not going to print money to get us out for a longer period of time. And that puts us in a potential recessionary period for 2 to 3 years at minimum.
Is it true that spending habits take a while to change? I mean, your income may change overnight if you get a promotion or if you lose your job, either way, but your spending habits, your way of life takes a while to adjust. So get this, right? The personal savings rate over the course of the pandemic spiked to record highs and then it quickly dropped down. People have been spending money once things opened up. And now the savings rate has dropped down to way below pre-pandemic levels. And the idea of people not spending money is really not supported by the data because they have been. Now the concern is that they won't have any money to spend. And now, of course, your habits stay with you because you've been spending all that money, Gareth. Where are you going to get money? You're going to use your credit card, roll up your debt, personal line of credit, whatever have you. Do you think personal consumer debt is still on its way up?
Yeah, so I do. And I think the consumer is getting more and more stretched. And at some point, you're going to see it reflected across the board in consumer spending. But you're 100% right. Changing your kind of ways of doing things. People are used to spending money, especially post-COVID. They wanted to go out. They wanted to do things. They said, who cares about running up debt? I want to get out. I want to travel. I want to see people. And I think that kind of mentality is very hard to break. And we've seen consumer debt, like you said, skyrocket, credit card debt, skyrocket, even car loans. Look at the defaults starting to hit on car loans. Like there is a tidal wave coming that should hit in the next 3 to 6 months that I do say, I will go on record and say second half of 2023, we will see the recession hit.
Second half of 2023. All right, let's talk about that quickly before we move on to stocks and Bitcoin. Second half of 2023, how severe will this recession be? Do you have any sort of idea of how high unemployment could go? Keep in mind that during the last Great Recession, 2008, we had employment go up to 10%, unemployment rather go up to 10%. We had layoffs across the board, across all sectors. The S&P 500 dropped more than 50% during 2008, all during the last Great Recession. Let's bring this back to today. Any similarities, any differences in this recession coming up?
Yeah, so to me, the recession is going to be a slow rolling recession. It's going to be one like the lobster in the hot water, and I hate to use that kind of imagery, but ultimately where it slowly heats up. And I think initially people are going to say, okay, it's not really going to be that bad, and the Fed probably calms us down by saying, oh, it's not going to be that bad, just like they said it was going to be transitory on inflation. So they have a tendency to understate what's going to ultimately happen, and investors have to be prepared on the other side for something much, much worse. But because it's going to last so long, it's going to continually get worse and worse and worse. But the Fed is unlikely to come to the rescue, at least for the first 12 months of this recession, due to inflation's high levels. So that's going to make it, by the end of this recession, it is going to be nasty. And I think we could be, and I said this before with you as well, I'm looking at no new highs on the S&P 500 for 10 to 15 years. I think that we're in a recessionary period for at minimum 2 to 3 years, and it could even be dragged out longer. Eventually, unemployment goes so high that even if inflation is 3%, the Fed will come to the rescue eventually and stimulate. And again, I'm talking unemployment could be north of 8 to 10%, and then they're going to be forced to stimulate to kind of bring that down.
Do you think that they will stimulate before the end of the 10-year period that you were talking about? Basically, when is the next quantitative easing cycle?
So I do think they will. I think probably within 2 to 3 years. So I think in the next 12 months, no, they're going to stick it out. But I think things will get bad enough. Mm-hmm.
That's interesting that you think that the Fed will stimulate in the next 2-3 years, but the markets will still not recover. So you're saying that the Fed, its impact in the market, at least from a bullish perspective, has waned, because next time they're going to ease, it's not going to go to new all-time highs, right? The markets?
Yes, I don't think so. And I think there's precedent for that, because if you look back at the dot-com collapse, remember that the Fed actually lowered interest rates following the dot-com collapse, and we didn't see technology stocks, the NASDAQ, hitting new highs for really 15 to 16 years. So again, I think the issue too in this scenario is that you're going to see them starting to print or lower interest rates, and then it's going to create a bigger inflation concern, right? So if you don't get inflation back into the box and close that box tight, you're going to have the stimulus creating this fear or reality of higher inflation for longer periods of time. And this is going to be a battle that the Fed is going to wage for years to come against inflation. If you think about it, look at how long we've been in a market with underinflation, with sub 2%. Well, you know what? When you're sub for a period of time, it's likely that you'll be over to even it out for a period of time. And that's going to make it so when you have inflation high, it's going to be very hard for the consumer to really continue to spend at the levels they are able to, or they want to, before obviously the markets get back to all-time highs.
Do you think there are specific sectors within the S&P that will do better than others, and what would they be?
Yeah, so I'm definitely into this. And the one thing I always like to say to people is that, when I come on, sometimes it seems like doom and gloom. But remember, as an investor, there are always opportunities out there. So for me, if we go to some of these charts, let's take a look at the charts and kind of take a look. So, where are some of the opportunities here? I'm liking something like an Amgen, right? Has come off significantly from the recent highs right into this low area of support. We saw actually when the markets were selling off in the last portion of the year of 2022, Amgen did very well. It's now come in as the markets have stayed more bullish. So you're looking for higher dividend names that are going to be safety plays, defensive plays. That's really where you want to hide. And then I've got to just go back to gold here. Gold continues, and I know in our December meet, we talked about how I still think gold will be the best performer in 2023 when comparing the S&P and Bitcoin, and it's having a beautiful pullback today. I started to nibble again on some gold opportunities here. I do expect by year end for us to at least retest the highs on gold. So there are opportunities. And again, I think people have to just be very, very careful. This is not a market to really put all your money in. You want to leave some dry powder on the side so that you can actually react when the opportunities pop up.
Okay, Gareth, let's move on to Bitcoin now. You have been correctly calling for Bitcoin's downside for the better part of the last year and a half, despite a lot of naysayers to your downside $20,000 call. Now you've updated that since with me, and you've said that the worst case, the absolute worst case, is $3,000. We're nowhere near there yet. And of course, that may imply a complete implosion of capital markets, does it not? Because it's correlated with the rest of the stock market.
Yeah, absolutely. And I think the key to recognize is that's kind of the unlikely scenario. But if we were to get into a cataclysmic collapse in the equity markets, in the Bitcoin and the crypto markets, then that likely would be the bottom. And the reason I came to that conclusion is essentially during the dot-com era, Amazon dropped 95% from its highs before obviously recovering to the record levels that it hit over the last couple of years. So that 95% mapped out to Bitcoin would bring us back to about 3,500. Now, for me, that's not really the likely scenario. I'm at a 12 to 13,000 high-end target with a low-end target of 9,000. But I'd just like to show you here. This is the chart of Bitcoin. And what we can see very clearly here is that we've had a big rally. A lot of people, like if you go on Twitter, they'll say, oh, it's the bottom. We're going to start a new bull market. I disagree. If you look at this M pattern, look at the M pattern. The second portion of the M is higher than the first. Now let's go back to the all-time highs on Bitcoin and look at that pattern. This is a classic topping pattern. So for me, what we've seen recently is actually a bear market rally. We've now come off of that 25,000 retrace with a bear flag. We then dropped, and we're now bear flagging with a likely downside move to at least 18,000 and change. And ultimately, I do think that we're going to see 12 to 13 and eventually 9. And think about this, right? You're in a scenario where if I'm correct that the economy is going to go into recession, then you're looking at the stock market probably with another 25 to 30% down from here on the S&P 500. Now, tell me how Bitcoin doesn't go lower if the S&P drops 25 to 30%. We know it's a risk asset, at least right now. That's the likely outcome to the downside, in my opinion.
Are we able to use historical precedents and technicals to draw a conclusion as to how long this bear market for Bitcoin would end? Keep in mind, in 2017, it peaked back then at around $20,000, came back down. I think it bottomed around $3,000 to $4,000 US, and then it stayed sort of flat until the new bull rally that we saw transpire over 2019 to 2020. Right. So that lasted maybe 2-3 years. Right. Now we're about a year and a half into this bear market, this stagnation, whatever you want to call it. That implies, if you look at historical precedents, just one more year, or perhaps a year and a half of stagnation before Bitcoin shoots up to the moon again. Yeah. Can you make that sort of analysis?
So a lot of people are, right? They're saying that generally the Bitcoin bear market, 2 years, give or take a little bit, like you're saying. And the issue here that I have with that is that, number one, we don't have a lot of historical bear markets in Bitcoin, 2-3 bear markets since Bitcoin's inception. The other issue is that if you look at when we came out of that bear market in 2019 to 2020, it coincided with the COVID collapse, which then triggered the Federal Reserve to print more money than we have ever seen printed in history. And so the question is we're now in this new environment where I think it doesn't mean that the cycle won't play out exactly like it has. It just means we have to, as investors, take that into account, that there is no printing of money going on from the Fed and interest rates are a lot higher. So there is a precedent now that if you map that out, the Bitcoin bear market could even last a little bit longer, much like the stock market bear market.
So then how are you positioned in terms of Bitcoin? Are you short right now? Are you out of the market? What are you doing?
No, so I have a couple positions short in crypto right now, and I do have a little Bitcoin on the long side as well. So I'm a little hedged. I'm kind of short alts right now versus being slightly long Bitcoin. But the key is this, is it's a very, very small position. And what I want people to understand is that you can still accumulate in this lower range. I'm still a huge long-time bull or long-term bull on Bitcoin. I still think it's going much, much higher than even 69,000. It's just you have to give it enough time to kind of digest what the Fed is doing and kind of cycle out all the weak hands. So again, for me, it's just going to be continuing to accumulate. We get to 15, we get to 13, we get to 10, to 5. I will continue to kind of accumulate with a long-term view. but I'm not going to be someone that's chasing it at 25,000 on a pop here. I want to be patient. I want to be disciplined. And that's really what traders are going to be, right? If you're a successful trader, you are uber disciplined.
Just a story. It's happened to me several times, actually. But when you were calling for Bitcoin to retrace $20,000, you first called it when it was like 55, 60. It was on its way up, not yet at its peak around 67, 69. But then I was in Montreal at the time, and I was walking down the street. This man comes up to me. He says, "Oh, I recognize you. I've been watching your show, and Gareth Soloway, your interviews with him. He's been calling for Bitcoin to go. Oh, I missed so much on the upside, just waiting for that $20,000. When's he going to be right?" A lot of people were frustrated at that call. You turned out to be right. Patience was all it needed, and I'm so certain that people watching this now are thinking the same thing. Oh, he's asking me to stay on the sidelines again. When can I just get back in? Right? There's just frustration.
Yeah, and
when
I
can
understand
we get
that.
back in?
Listen, patience is the hardest thing to be. And the beauty of it is this, right? Is that I've been wrong on trades before. I've been wrong on many. But the key is that what I always understand as a technical trader is that if I miss one today and I'm wrong on it, there's always another one tomorrow. And that's the beauty of trading gold and silver and Bitcoin and ETH and stocks. And I mean, there's just so many things to trade that who cares if I miss one? Heck, I miss them every day. All you got to do is capture one or two here and there, and you become a millionaire.
What are the technical indicators you would look out for a Bitcoin bottom, and then you would definitively get back in with confidence?
Yeah, so the things that I would look for is all-out panic, which we haven't seen. Even when FTX collapsed, you didn't get a crazy amount of panic. You still had a lot of bulls that were still ready to say, no, don't worry, this is going to be fine. It was kind of the closest thing to that, which did mark a short-term low. But I still think you have to get to a point where, like in 2019, when we were at the lows, I still vividly remember CNBC had talked about Bitcoin every day, and they had the ticker of what the Bitcoin price was every single day. And by 2018 into 19 in the bear market, they took it away and they never talked about it. And that was a signal to start accumulating. So essentially, when everyone else turns ugly bearish, where they're starting to write it off, that's when an investor like myself starts to inch in. I also think you look for technical levels like the pierce of 10,000 to the 9,000 target. Think about how many stops will be right at that 10,000 level that'll get wiped out. You'll see major panic below 10,000 because it breaks the even number. Those are the signals that I kind of pay attention to.
And when you're trading Bitcoin, do you use the spot market on exchanges? Do you use a DEX? Do you use futures, derivatives?
I use spot. Yeah, definitely spot. I like being in the pure form of it. I like owning Bitcoin itself. That makes me feel more comfortable. The futures, again, you get the rollovers of the contracts and other things like that. So for me, I'm just a pure form, on the spot.
Okay. Now let's talk about gold. You are long-term bullish on gold. In fact, you've told me that gold will be the best performing asset in 2023. You've said that about 2022, and relative to stocks and Bitcoin, you were right. This year, give us the macro sort of thesis for why gold will outperform again.
Absolutely. So right now, gold is, if you look at a horse race, gold is lagging a little bit, especially behind crypto as of now. I think with the stock market, it's slightly lagging as well, but not by much after the recent selling action. But the bottom line is you have to go back to the bigger picture here. And what we see is an economy that has a lot of uncertainty. You have all the macro issues. You have higher inflation potentially for longer. And even though interest rates are inching up, the Fed will be forced to step on the side of interest rates and stop hiking, at least in the not too distant future, due to a weaker economy. That's going to hurt the dollar. The dollar will start to fall, and gold will start to break up. And what I love about this chart, you had a breakout, right? So here was your downside move here, little W bottom, and then you rallied up, you broke out, and then you retrace to the scene of the crime. You're getting a good pullback here. To me, this is a buying zone right here. Keep buying in this area. I expect it to break this down sloping trend line around 1945 to 1950, probably within the next month or two. And then I think off to the races, we go to the double top of 2070. So for me, the charts are in alignment. I think I've talked to you about this before. If you look at the 1970s into the 1980s, the replication of the chart almost perfectly is occurring. And what we saw was this up move from 2018 to 2020 recently. In fact, I can zoom out and show you guys from 19 all the way to 2020, almost 2021. Then we've been consolidating for 2 to 3 years. In the 1970s, you had the same thing. You had 3 years up, 2 to 3 years consolidation, and then a 10x on gold. Now, I don't think you're going to do 10x. Don't get me wrong. Don't quote me on that one. I don't think it's going to be 10x, but do I think it's going to be 3x over the next 3 years? Yeah, I do actually. I do think that we'll be north of 5,000 an ounce within about 3 years as the bear market takes hold, as inflation doesn't get back in the box under 2%. People are going to look for that safety of gold.
Just one challenge to that, and we'll end the discussion on markets here. Don't you think that the higher interest rates that you yourself said would persist this year would be a headwind on gold, given that we know the yellow metal is inversely correlated to real interest rates and the dollar?
When interest rates are rising, yes. What you'll see and what we saw here, right? So starting in November of 2022 on this chart, look at the run gold had. That wasn't because people said, oh, the Fed is going to start cutting rates. It was just because they were going to pause. And that's what I'm expecting now too. So you're basically, now you're seeing a down day today as Jerome Powell's testimony in front of Congress was very hawkish, maybe a 50 basis point hike. But again, as soon as the Fed goes to the sidelines and just stops hiking, that's going to be the green light for investors to rock into gold and gold to skyrocket. And I actually expect a measured move. Like you take this low here at around 1620 or so, all the way to about 1900 here, you should get a replication move, which guess what? Takes you basically up to the all-time highs up here. So it's not so much the Fed, basically needing to cut rates. It's just stopping the hiking will then push money into gold.
Great summary of trades and markets, Gareth. We'll get you on next time to talk about specific stocks you like. Tell us a little bit about your philosophy as a trader and what we can learn from Verified Investing Education, because not everybody might know this about you, but not only are you a good trader with an 80% batting average, but you are also a good educator, which you're showcasing now on your education platform, VIE. Tell us about that.
Absolutely. So by the way, this is an interesting story. I don't know if I've ever told you this before, but when I told my parents I was going to go into the stock market, my mom was so upset. She said, oh, all these rich, people and all these, they're greedy. I wanted you to be a teacher. That's what both my parents were teachers. So what's interesting is that even though I did get into trading and I've done that, I've helped people and I've educated. And really my next phase was to do this course on Verified Investing Education, where I teach everything from the mental discipline, the market psychology, to every technical setup that I look for, every secret I know, and it's all in there. And so, Mom, if you're watching, I kind of did follow in your footsteps after all.
Okay, well, you can't reprimand a student for misbehaving during your class. That's the difference between mom and yourself, right? You can't kick them out and give them suspension or detention, but you can't teach them how to be a good trader. What's the feedback you've been getting on this program?
Oh my goodness, you wouldn't believe it. The people telling me that it's changing the way they view themselves, the market, how they can apply it to things in their life, even outside of trading. That's what it is. It's applying mental discipline and the charts, which are basically human nature, that can be used everywhere in your life. And it's amazing the comments that people are giving me because of taking these courses.
All right. Well, congratulations on the success on both InTheMoneyStocks.com and VIE, and I look forward to discussing both of these things and your trades with you next time on the David Lynn Report. Thank you for joining me, Gareth. Thank you for coming on today.
Thank you, David, and congrats again on your show.
Thank you. And now a word from our sponsor. Equiton helps investors build their wealth by offering easy access to all types of investment-grade real estate through their proven, high-performing real estate investment options. Equiton offers true diversification, full transparency, and all the benefits of real estate investing without the difficulties of financing, tenant management, building maintenance, or project management. Be sure to click on the link down below in the description box to learn more about their projects and funds. Thank you for watching the David Lynn Report.